I am very excited today to talk to a badass woman in the real estate space. She's not only a CPA, tax strategist, but a real estate investor, author of one of Amazon's top sellers, Tax Strategies for the Savvy Real Estate Investor. She's seen on Bigger Pockets podcast, Money Magazine, and CNBC. Amanda Hahn, she does it all, and I'm so excited to be talking with you today.
Awesome. I'm so excited to talk to you.
I know. I'm so excited too. Were you always focused on the real estate side, or how did that come to be with Bigger Pockets?
I read the Rich Dad Poor Dad book and started to think like maybe I should do it too. I clearly see the tax savings. So
Right.
why not me, right? But
That's
before
the
then,
book
I
I feel
never
like
thought about it.
I read Rich Dad Poor Dad. Our founder read Rich Dad Poor Dad. Like that is everyone I talk to, it's like that is the pivotal breakthrough book for a lot of
Yeah, for
people.
sure. So since then, my husband and I, we started our own firm. Because basically when you're working in the big firms, you're doing tax strategies for like really large real estate companies. And when we started investing, we started going to networking events and things like that, and just meeting everyday investors. And
Right.
we realized that there were no tax strategies for like the newer investors or just everyday investors. It was only available for people that had, very large amount of net worth and things like that. So that's why we started our firm. Like, hey, same strategy, just on a different scale. So we've been really fortunate to be able to, choose to work with real estate investors, and because we're investors ourselves, so
Right.
we get the benefit of seeing from our clients financials, like what's working, where are they investing. So a little cheat sheet, I guess, for us.
I have a lot of friends in the space that contact me now that I'm in the real estate world every day asking me, what can I do to save on my taxes? Because they're high level executives, W-2 employees, but they're spending a lot of money on their taxes. I mean, that's $100,000 a year.
Yeah, it's really interesting because if you think about it, most wealthy people um, have real estate. If you
Mhm.
look at some of the, traditional people that they talk about in the news media, they all have real estate as part of their portfolio or a pretty big part
Yeah.
of the portfolio. And part of that is because of the tax savings and the tax benefits. So, the reason that this is the case is because the government really has a set of rules that incentivizes us to invest in real estate and provide housing for the general public. So as a real estate investor, you're basically a business owner in the eyes of the IRS, right? You're
Mhm.
in the business of real estate investing. And so what that means is you can take tax deductions and write-offs as a business owner. So when you hear people say, oh gosh, the business owner gets to write off part of their car or like a home office or their travel expenses for business, that same exact concept applies to us as real estate investors. And earlier we were chatting about this whole concept of business. A lot of people
Right.
mistakenly think business means like an LLC or a corporation. I got to go out and form an entity, but that's actually not the case when it comes to the tax world. If you are someone investing in real estate, let's say you have a rental property, you're a business owner, regardless of
Mhm.
whether you have an entity or you hold it personally in your name. So you're able to take advantage of those tax benefits and tax deductions either way, right? But the key is to invest, whether
Right.
it's single family, multifamily, short-term rental, long-term rental. Being an investor is what makes you a business owner, in addition to maybe like a W-2 job.
Got it. Okay. Yeah, because that's the thing too. There's some confusion that I have, understanding as a W-2, but I do own real estate that is a rental property, and just knowing how much can I really take advantage of there. Like what can I do to maximize, against my W-2 income? And I know there's, you hear the terms like depreciation, obviously that's a common term, bonus depreciation, accelerated depreciation. How would you, in a nutshell, kind of break that down for people like myself who are relatively new to the game?
Yeah, like the 1 minute, see if we can cover in
Yeah,
1 minute, huh?
no,
Uh,
that's going to be a real big challenge.
I know the TikTok version. So again, this is a set of rules that the IRS allows us to use because we're providing housing for people. So the way it works, if you have a rental property, let's say we bought something for $120,000, our building is $100,000. The IRS says, okay, this $100,000 building, there's going to be wear and tear as you own and hold this property. So I'm going to allow you to take a write-off or a depreciation on that $100,000 over the next several years, right? So we're getting to write off part of that $100,000 building. So normally for residential real estate, it's 27 and a half years. So simplest
Okay.
form, I have 100,000 divided by 27.5, and that's my depreciation write-off every year. And we call that a paper loss because it's not really cash flow, right? It's just a
Right.
tax calculation, you get a write-off. Bonus depreciation, cost segregation, that's just a more advanced strategy to accelerate that depreciation. So instead of saying we have a house, write it off over 27 years, maybe I can take out the components. I can say, there's 30,000 of flooring or 10,000 of specialty plumbing. And when I break out those components, I might be able to write off 100 or 80% of that immediately in the first year. So this is where you're hearing people say, oh, I bought a rental property last year. I used accelerated depreciation and I got a $100,000 or $200,000 tax loss. It doesn't
Wow.
mean they
Yeah.
lost money. It means they're
Right.
using strategies to create a paper loss for tax purposes. So it's like instead of paying taxes, if I made 20,000 of rental income, instead of paying taxes on that, I'm not paying
Right.
taxes on the rental income because I have all these paper losses and write-offs against that income. And this is really important, especially like you were saying, for a lot of people in your network who are high W-2 income. That generally means they're paying very high tax rates, right?
Right.
Federal and state, because we all know as W-2s, there's not a whole lot we can write off against it. And so real estate is a way for anybody to create more income through cash flow and appreciation where they don't have to pay current taxes on it, right? Because
Okay.
we have these types of write-offs. But so I think again that's available for anybody, even if you have one rental property out of state, you never see it or do anything with it. But I think a lot of people also want to know, like, how do I use rental losses to not just offset my rental income, but also offset taxes from my W-2 income too,
Exactly.
right?
Yes. Yeah. How do you do that is the big question.
Yeah, that's the next goal, right? And that one is a little bit, you have to take a couple extra steps beyond that. Like I said, everybody can use depreciation and all that to offset rental income, right? That's just available to anybody. But if you're wanting to use it to offset W-2 income, there's two main sort of categories or loopholes that you're going to try to go after. And which one you go after depends on whether you're investing in long-term rentals or short-term rentals. For long-term rentals, again, assuming we have higher income, that's defined as anyone over 150,000, okay, of AGI. So if you have over $150,000 of income, your rental losses only offset your rental income. If you have more losses than you need, they will offset future rental income. If you wanted to offset W-2, the way to do that is for you or your spouse to qualify as a real estate professional.
Yes. There we go.
So if you make over 150, you have long-term rental losses that we created strategically. And you want to use it to offset W-2 income, either you or a spouse needs to qualify as real estate professional. So there's 3 rules that you have to meet for real estate professional. The first one is that you spend at least 750 hours in real estate. So that's for the whole year doing real estate stuff. If you happen to be a realtor or broker, that's also real estate, right? So real estate property manager, all kinds of stuff is real estate. The second rule is you have to have more time in real estate than your job. And this is the one that's going to be harder for people who are
Right.
working W-2. So if I'm like a doctor working full time at 2,000 hours, I have to have more than 2,000 hours in real estate to be a real estate professional. The third one is that you have to meet material participation on the rentals themselves. So there's various different ways to do it. The most common one is you spending at least 500 hours on your own properties. So the distinction will be like, if you're a realtor or a broker, you're helping people sell homes and you have over 750, that's great. But within that 750, you want at least 500 of those to be on your own properties.
Got
So
it.
I'm
Oh,
doing
that's interesting.
rents and things like that. Okay.
Got it.
So
Okay.
if you meet one of those, if you meet all 3 of those, then you're a real estate professional. And then it's kind of like, the doors open, everything is beautiful. You have all these real estate tax losses, offsetting your W-2 business, all types of other income. If you can't meet that, then, the next best thing is if you have a spouse who is able to meet that, right? So if you have a spouse that's not working, or if you're the non-working spouse, if you meet those requirements, then you can also use the loss to offset both people's income as well.
Okay. That actually is the simplest way I've ever heard it. That makes complete sense. And you know what I take away from this is I need a spouse.
You know, this is so funny because we joke around when talking to Bigger Pockets that there should be a Bigger Pockets Match.com or
Oh
something
my gosh,
where you're just
please.
marrying, real estate people with non-real
Yes.
estate people. I mean, I think that's the best thing, you know?
That would be the best idea ever. They need to get on that. Sign me up. I'd
Yeah.
be their first
Sign me
participant.
up. Yes, yes. And it also depends on kind of like what your full-time job is too. Again, if
Mhm.
your full-time job is being a realtor or a broker and you're getting paid as a 1099, for example, then you're already real estate, right?
Right.
You don't have to compete with like a W-2 job or something like that. So then it's really just about buying enough properties or owning enough properties so you get the number of hours. But if you can't qualify, you don't have a spouse yet to qualify, or your current spouse doesn't qualify, then the next best thing to do is to look at the short-term rental loophole. And this is such a popular one right now, just because this is one of the only ways to use rental losses if you
Mm.
have both or one person with very high W-2 income and can't be a real estate professional. So for short-term rentals, if you invest in short-term rentals and you strategically create these losses, you can use the losses to offset all your other income, as long as you meet material participation. So we don't have to worry about real estate professional anymore. We don't care how many hours you're working at your W-2 job at all. We just care about how many hours you're spending on the short-term rentals. So there's 7 different ways to qualify. The most common ones are that you spend at least 500 hours on your short-term rentals. So that's
Mhm.
acquiring it, staging it, dealing with the guests and all that. If you spend 500 hours, then that's it. You're done. You can use the
Yeah, that
losses
seems
to
pretty
offset all your
manageable.
income.
Yeah.
Yeah, pretty manageable. And it gets even better. If you don't have 500 hours, you can still use losses if you have at least 100 hours and nobody else spends more time than you. So if Kristen had, 110 hours and your cleaning crew only had 80 hours, your landscapers only had 30 hours, then you also would have met material participation, which allows you to use the losses against W-2 income.
Okay.
So that's a second one. And the third one, again, there's 7, but there's top
Yeah.
3 we see
These are the
time and
top
time
common.
again. Yeah. So the third one is you have any number of hours, but that's more hours than everybody else combined. So if Kristen had 80 hours, and if we look at the cleaning crew, the landscaper, repair people, they only had combined 30 hours, then you would have also met those requirements and you can use your
Wow.
losses on your tax returns.
There's so many clever ways. And I think this just reiterates the importance of getting with a CPA who knows how to maximize these benefits.
Yeah, and I think, like I said, the more income you make, the more important it
Yep.
becomes, right? So if you're a high income earning couple, you're probably, I mean, depending on what state, but you're probably paying close to 50% taxes.
Yeah.
So if we bought one short-term rental, we accelerate the depreciation, we're writing off all the furnishings, we created $100,000 tax loss, that could be a $50,000 tax refund for you. And that 50,000 could be a down payment on your next rental property,
Your
right?
next
You could
one.
buy another
Mhm.
property and you do the same strategy again the following year.
Right.
So really powerful. The more money you make, the more important it is to save on taxes.
Yeah. This is so insightful. You're amazing. You're awesome.
Thank
I'm going to
you.
send everyone to you. I'm going to send all my friends to you. This is awesome.
Thank you.